Good morning, everyone. Hope you're well. Hope you're doing alright, guys. I've been trading for 12 years so far, and any track record that was ever presented to me, I was capable of finally turning profitable. Today, I want to share with you the framework that I use, which is called environmental dependency, that when using it, I can turn any track record that is presented to me into a profitable track record. Right? Let's get right into it. Now, this is the average unprofitable trader's track record. This is how it looks like. Now, people imagine that an unprofitable trader's track record looks something like this, in which an unprofitable trader will just simply lose money forever up until, after hundreds of trades, blow out their accounts. This is what people imagine. However, that is not realistic. No trader's track record looks like this. If your track record looks like this, where you simply lose money all the time and you never write, you never make money, that means that you have been blessed with a gift. You're one of the luckiest people I know. You are consistently wrong. That is a gift that you can turn into a money printing machine. If you are consistently wrong and you are never right, then all you have to do is whenever you think that something is going to happen, just do the exact opposite. Your take profit goes where you think your stop loss should be. That's it. You reverse your decisions and then you make money forever. And therefore, that is not an unprofitable trader's track record. This is how people imagine it. However, it is not like that. The average unprofitable trader's track record looks something like this. This is you. This is the majority of people watching. You make some money, you think everything is working out beautifully, and then boom, suddenly you wipe out your profits and you're like, fuck, I just got into a losing streak. And then you start making some money again and you're like, okay, things are working out very well for me. It looks like I finally attained profitability. And then boom, you wipe out your profits. And then you're stuck, you're consistently stuck in that cycle. If your track record looks like this, I can easily turn it profitable. If your track record doesn't look like this, then I'll give you tips in order to turn it like this, and then we can turn it profitable. So, what kind of track record can you have if not this? It's a variation of this. Let's talk about it. Let's say you're a very aggressive trader. Let's say this track record in front of us right here is the track record of a trader that risks 0.5% per trade. But let's say you are a lot more aggressive and therefore you decide to risk 10% per trade. So you're taking 20x the risk of the average trader that has this track record. If you are taking 20x the risk, then you will suffer 20x the rewards and you will suffer 20x the drawdown. So obviously right here, as the market goes up, if you're taking 20x the risk, then you will be rewarded with 20x the rewards. And as the market goes down in the opposite direction, or as your track record goes down in the opposite direction, you will suffer 20x the drawdown because you are risking 20x the amount of risk that the average unprofitable trader is taking. And therefore, your unprofitable track record will look something like this. This is a variation. A lot of people have this track record right here, in which they will start trading, they will make a lot of money. And I've interviewed a lot of traders that tell me, Roy, I know how to make money. Last year, I took a $100,000 account into $175,000 or $200,000 or whatever. I've been capable of doubling it. I know what I'm doing. I doubled my account. I've been doing very well. But eventually, unfortunately, I blew my account. As you guys can see. Why is that account blown? Because if you're suffering 20x the drawdown right here, that drawdown would be enough for you to reach zero and for you to blow your account. So you don't get to experience the other ups and downs that exist right here. You only experience the first one. You make 20x the reward and then you make 20x the drawdown, and that's enough to get you to zero and to blow out. The problem with those traders is that they would blame the fact that they blew out right here on some psychological factor. They'll be like, oh yeah, I made a lot of money, but I don't know suddenly what happened. Maybe it was psychology. Maybe it was my mindset. Maybe, I don't know, I got into a very bad zone and I started losing trade after trade after trade up until I blew the totality of my account. When reality is, the reason why you blew your account is because this is how your unprofitable track record should look like, but instead, this is magnified 20x because you're risking so much. And therefore, for those traders, if this is how your account looks like, in which you made money, let's say when you first started trading, and then boom, you blew your account, all you need to do is just minimize your risk. That's it. If you minimize your risk, then you are going to turn that track record right here into this one right there. And from that, we can turn that profitable because as I told you, this is the track record that when you apply the framework that I'm going to teach you, you're going to be capable of turning that track record profitable. So if you have this track record, minimize risk, and then boom, you turn it into that track record in which we can apply the framework that I will teach you and turn it profitable. Now, the second variation that I've seen of that track record is the emotionally exhausted trader, in which a trader will be stuck in that cycle for a while, make money, wipe out profits, make money, wipe out profits, make money, then losing streak. And then eventually, at some point right here, they will get frustrated of consistently being stuck in that cycle. So what they'll do is they'll take a lot of emotional decisions, they'll increase risk, they'll revenge trade, they'll start using systems that are outside of their normal trading process, and they'll just do weird shit, basically, okay? Psychological, emotional stuff. And as a result, this is how their track record will look like. They will go into cycles of I make money, wipe out profits, make money, wipe out profits, make money, wipe out profits, then frustrated. Oh fuck, I've been stuck in this cycle for 400 trades, I'm frustrated, I can't seem to make money, they start revenge trading, doing all that up until they blow their accounts. Now for this trader right here, the solution in order to turn that track record into this, the solution is to remove emotional exhaustion. Now in that case, I would have one-on-one time with that trader and I would basically teach them about some of the mental models that I use, how to accept losses, how to accept the fact that you're going to miss out on some trades, how to not revenge trade, how to not fear the market, how to not be greedy, all that. So a lot of mental models that we get into in order to remove emotional exhaustion right here, so we can turn that track record into this track record. Now, we're here, right? If you're a trader that risks a lot, you risk less, you're here. If you're an emotionally exhausted trader, you adopt some good mental models that allow you to not be emotional on the charts and allow you to stick to your system, and then you're here. So now we're here and we want to turn that track record into a profitable track record. So how do we do that? Let's get right into it. Quick disclaimer, everyone. There's a lot of usernames on social media that resemble my username, and they are messaging you guys, offering you all sort of services, asset management, crypto, brokerage. Those are not me, guys. I will never DM you first. The only way for you to possibly become one of my 5 students for our next lectures is through the link in the description. That's it. There is no other way. There is no shortcuts. There is no DMs. There is no... I don't know what they're offering you at this point, but there's none of that. Beware of scammers. As I said, the only way is through the link in the description. Let's continue with the video. Alright, as you can see, it's night time. I had to take a few meetings, but here we are. Now, how do I turn that unprofitable track record here to a profitable track record? You know, guys, whenever that track record, something similar, is presented to me, I always ask the trader that presented it to me. I'm like, if you want to turn that unprofitable track record profitable, what would you do? And the majority of traders have the same answer, which is, they say, you know what, Roy, last month I ended it in a minus 2% drawdown. If only I could have taken one additional trade, one additional win, a 1 to 3 risk to reward ratio trade with a 1% risk, I would have ended the month in profits. And therefore all I need is this one additional profitable trade per month, a 1 to 3 risk to reward ratio, and then I would be profitable. What I mean by that is that the majority of unprofitable traders try to solve the unprofitability problem via the addition of winning trades to their portfolio. They think that there is going to be some source, some independent source, that will give them one additional profitable trade per month for them to become profitable. As you can see from the way that I'm explaining it, I don't believe that this is the right solution. You will not find an independent source that will offer you one additional profitable trade per month for you to get pushed into profitability. That source doesn't exist. And therefore, how do I solve the unprofitability problem? I solve it via the reduction of trades, via the reduction of losses. Let me explain that further. Let's say we look at this track record right here. I focus on the drawdown and I ask myself one question. How can I possibly reduce the drawdown? So I go ahead and I start studying the losses that are presented in that track record right here in order to figure out the patterns that exist in common between these losses right there. And once I identify patterns that exist between losses, I try my best to avoid trading when these patterns show up the next time. And by avoiding trading when these patterns show up the next time, I reduce the amount of losses that I am taking. If I can take that track record in front of me and I can reduce the amount of drawdown right here by just 50%, I don't want to remove it all. I don't want to understand all my losses. I just want to understand some of them. If I can remove 50% of my drawdown, then I get this track record right here, which is the track record of a profitable trader. Now, how can I identify the patterns that are leading me towards losses so I can avoid the trading when those patterns show up the next time? Now, on my journey to figure out what is causing the majority of losses right here, I figured something that I call environmental dependency. Environmental dependency simply means that trading systems make money in certain environments and then bleed money in some other environments. And if I can figure out the environment that these systems make money in and the environment that these systems bleed money in, I can start avoiding trading when the bleeding money environments show up. And then I would only trade in the environments that favor my trading system. So how can I figure out what is the appropriate environment for my trading system to use my trading system in that environment? And what does environment even means? Let me go ahead and explain that. Let's first of all explain what environmental dependency is. Systems don't make money everywhere, as I just said. Every system has an environmental dependency, which means that every system makes money in certain environments and bleeds money in certain other environments. And our job as traders is to figure out the environments that help our systems make money and figure out the systems that lead our figure out the environments, that lead our systems to bleed money so we can avoid the trading when these bleed money environments show up. For example, I'll give you a small example. A breakout system, so a normal, let's say you draw a trend line and when that trend line is broken out of, you take a trade. Or you draw a resistance line and when this resistance line breaks through to the upside, you take a trade. A breakout system thrives in impulsive markets environments, periods when volatility expands in one direction. So if we see an impulsive market that is consistently expanding in one direction, that market would play out very well with a breakout system. I gave a small example right here, which is gold 2025. Let's go to gold 2025. As you guys can see here, for gold this year, it has been very impulsive through to the upside. So if we use a simple breakout system, which is we draw a trend line, when it's broken, we take a trade. We draw a resistance line, when it's broken, we take a trade. When it's broken, we take a trade. When it's broken, we take a trade. If we just use a breakout system in 2025 on gold, we would have made a lot of money. So the impulsive environment, when volatility expands in one direction, that environment favors breakout systems. It leads breakout systems to make a lot of money, right? Now, that same system right here, the same system, which is the breakout system, bleeds money when used in indecisive market conditions. Indecisive market conditions means market conditions in which the market is simply hovering around between 2 points. In this market, breakout systems bleed money. For example, we look at Bitcoin in 2025. Right here. Look at Bitcoin. Bitcoin has been really indecisive since almost half of 2025. We got to all-time highs, and then the market started hovering around and being undecisive. And if you used Bitcoin, if you used the breakout system during this period right here, you would have lost a lot of money. Every time the market broke through to the upside, it came back down. And anytime the market broke through to the downside, it came back up, as you can see. So every trade, every breakout trade that you would take would almost result in losses, because the market is simply hovering around the point, and anytime it breaks to the downside, it goes back up, and anytime it breaks through to the upside, it goes back down. So a breakout system, as you can see, bleeds money in an indecisive market condition, and it prints money when used in an impulsive, when volatility expands in one direction type of market condition. So as you can see, if we go back to the chart right here, if that is the chart of a breakout trader, if a breakout trader presents that track record to me, I will assume that right here, when he's making money, he's using his breakout system in impulsive market conditions. And right here, when he's losing money, he's using his breakout system in indecisive market conditions. And that's why they end up bleeding money. So right here, the market was impulsive. Let's say he was trading and the market was impulsive. Everything was good. He was making money. And then at some point, the market flipped. It became indecisive, like Bitcoin, for example. When it got to that $125,000 level, that all-time high, it started hovering around. So he gets to a phase where the market is undecisive. It keeps going up and down. And in that environment, that system bleeds money and he ends up wiping out his profits. So the goal here is, basically, let's go back to here. When you use a system in a condition that hates it, in that case, when you use a breakout system in an indecisive market, it taxes you for your ignorance. As simple as that. You failed to identify that right now we are in an indecisive market condition, and therefore, because you failed to identify that, you used your breakout system in that environment, and as a result, you got taxed for your ignorance and you lost a lot of money. So the next question is, how can we identify what market condition are we in right now, so we know whether to use our system in that market condition or not? We will talk about that. I will show you live and historical chart examples on how to identify the right environment for your system. All right, we're going to talk about this. So there's two questions basically that I want to try and answer. Number one, how do you identify the right environment for your system? That's number one. So what is the environment that makes your system print money? Number two, how do you identify which environment are we in right now, so you know whether to use your system or whether not to use your system? Let's get right into that. The best way to answer those two questions, guys, is to give you a live chart example. I want to show you the chart. I want to speak about Bitcoin in that case. And as I'm giving you this example, you guys will understand the answers to my two questions. Let's get right into it. Let's analyze Bitcoin from 2021 all the way to 2023. And as I explain it, you will understand the answers to those questions. Now, throughout the years, guys, I've analyzed Bitcoin and I've realized that Bitcoin goes up when liquidity is expected to expand. What I mean by that, when people have excess cash, they tend to buy crypto. Let's say my salary is $2,000. And with my salary, I barely am capable to pay my rent and eat and afford my shelter and my food, basically. Afford my expenses. Now let's say for the next month, I receive a bonus. Or the government distributes stimulus checks. Or the government prints money and gives that money to me. I will use this excess cash to buy crypto. So we've seen, and there's a way to measure it. There's an indicator, I will show it to you. There's a way to measure how much money, how much liquidity people have. And the more liquidity, the more money people have, the more crypto goes up. They correlate amazingly. And I will show it to you. There's an indicator when we talk about that. It is the same thing in the opposite direction. Bitcoin goes down when liquidity is expected to contract. When people have less money, the first thing that they sell is their crypto. Let's say right now my salary is $2,500, whatever. And usually I have excess cash and I use my excess cash in order to buy Bitcoin. It's totally fine. So I have some crypto set aside. Now let's say for that specific month, for one specific month, I am tight on money. Let's say prices go up, inflation goes up. And as a result, I'm tight on money because everything is more expensive and I barely have a $2,500 salary. What people do, the first thing that they sell, they don't sell their gold, they don't sell their houses, they don't sell their stocks. The first thing that they sell, and also I will show it to you, the first thing that they sell is their crypto. So when liquidity is expected to contract, when people are expected to have less money, and there is a way to analyze that and predict that, crypto is also expected to go down. To summarize, when liquidity goes up, when people have excess cash, they buy crypto. When people don't have excess cash and they are tight on money, the first thing that they sell for cash is their crypto. And therefore, liquidity and crypto and Bitcoin, they correlate. And we're going to look at this chart right here. There's something that is called global M2 supply. Global M2 supply measures the amount of money, the amount of liquidity that is existent globally. And we've seen throughout the past years that Bitcoin correlates amazingly with liquidity. You can see when liquidity went down right here and reached the bottom, Bitcoin also went down and reached the bottom. When people have less money, less liquidity, the first thing that they sell is their crypto. And therefore, that's why crypto correlates heavily with liquidity. As soon as liquidity starts going down, crypto starts going down with it. And as soon as liquidity starts expanding through to the upside, which means people are having some excess cash, they go ahead and they buy crypto with that excess cash. And that leads Bitcoin, for example, right here to go through to the upside. Now, let's go to the charts. Now, before we go to the charts, I want to explain something essential to you. There is a way to predict where liquidity is going. There is a way to predict whether people are going to have more money in the future or have less money in the future. And as a result, I can predict if people are going to have less money in the future, it means that they are going to sell more of their Bitcoin, and it means that Bitcoin is going to go down. If people are going to have more money in the future, it means that they're going to buy more Bitcoin, which means Bitcoin is going to go up. There's a way to predict that. How do we predict that? One way to predict that is interest rate decisions. When the Feds or when central banks lower their interest rates, what ends up happening is they make borrowing cheaper, right? If right now the Feds are like, hey, you can borrow from our banks for 1% interest. Everyone will go to the bank and borrow money because borrowing is very cheap. As a result of everyone borrowing money, people will have more money, will have more liquidity. As a result of them having more liquidity, prices of Bitcoin usually go up. So prices of Bitcoin usually go up in scenarios in which interest rates are going down in central banks. As a result, as I said, borrowing is cheaper, people have more money, they buy more Bitcoin. Now, when interest rates are going up, let's say the Feds are like, okay, 4% interest rates, 5% interest rates, 6% interest rates. Borrowing money becomes very expensive. If I borrow money, I have to pay you back that capital plus 6%. That is very expensive. Now that borrowing is very expensive, people borrow less money. As a result of people borrowing less money, it means that they have less money. As a result of them having less money, that leads them to buy less Bitcoin and to sell their Bitcoin because they need cash. They cannot borrow money. Borrowing is very expensive. And therefore, they sell their Bitcoin for cash. And therefore, we see Bitcoin prices going down. So basically, what I'm trying to say here, raising interest rates leads people to having less money. And as we previously discussed, having less money leads Bitcoin prices to going down. Lowering interest rates makes people have more money. And as a result of people having more money, that leads Bitcoin prices going up. I will show it to you on the charts and we will discuss it for Bitcoin specifically. Let's get right into it. Now, let's recap what I said and then see it on the charts. When interest rates go down, Bitcoin is impulsive up. When interest rates go up, Bitcoin is impulsive down. When we don't know where interest rates are going, we're confused. Will the Feds raise rates? Will the Feds lower rates? Will central banks raise rates or lower rates? We don't know. When we are confused, that creates an indecisive market, which means it creates a market where it constantly goes up and down, goes up and down, goes up and down. All right, let's see it on the charts. In 2020, right here, COVID happened. Right? After COVID, the economy was destroyed. So the Feds and also other developed central banks wanted to stimulate the economy. So what they did right here is they brought interest rates all the way down to 0%. They were like, everyone can borrow for cheap because we want to stimulate the economy. We want businesses to borrow money so businesses spend that money on expanding their business activities and hire more people so the economy can be stimulated. So they brought interest rates all the way down to 0%. That's number one. Number two, the government printed money and distributed stimulus. I don't know how to write stimulus, but anyway, checks. All right, so they gave money to people. As a result, people had excess cash from the interest rates that are at 0% and from the stimulus checks that were distributed to people. All right, people had excess cash. They used some of that excess cash to buy cryptocurrency like Bitcoin. And as a result, in 2020, crypto shot up from $10,000 all the way up into $60,000 right here, 6x in 2020. That lasted from 2020 all the way until the end of 2021. If you were a breakout trader, as you can see, the market was very impulsive, trading by the end of 2020, bullishly through to the upside, every time a breakout happened through to the upside, you would have made a lot of money trading Bitcoin. Your system would have printed money. Now, let's go to late 2021, right here. What happened here? Russia and Ukraine went to war. As a result, oil prices surged through to the upside. As a result of oil prices going up, what ended up happening is inflation went up tremendously. In most countries, in Europe, in the UK, in the USA, the UK had 10% inflation at some point. Their prices went up 10%. Fuel prices rocketed all over the place just because of oil prices going up tremendously. And therefore, inflation went up tremendously. When inflation goes up, when things are more expensive, people are tighter on money. Right? Because things are more expensive and therefore they need more money to afford the things that are more expensive. As a result, the first thing that they did is they sold their crypto. They started selling their crypto. Now, on top of inflation going up, in order for central banks to combat inflation, they increase interest rates. So the Feds, for example, increased interest rates from 0% all the way almost to 4%. Interest rates went up, and therefore borrowing also became more expensive. As a result, people had less money as a result of inflation going up, and they had less money as a result of interest rates shooting through to the upside in most major countries. Europe, UK, USA, everyone was raising their interest rates in order to combat that very high inflation right here. As a result, that's less liquidity for people, and as a result, we saw Bitcoin melt through to the downside for the rest of 2022. Now, right here, when we reached 2023, what ended up happening is that inflation went down. Finally, went down. However, interest rates were still high beginning of 2023. And therefore, investors were confused. Will the Feds and central banks lower interest rates again since inflation went down? They were confused, as if inflation is down, why don't they lower interest rates? Why are interest rates still high when inflation is down? Will they lower interest rates? Will they keep them higher? What they will do exactly? Investors were confused. Everything was very clear so far. We had COVID, we had a bad economy. They will lower interest rates in order to boost the economy. We had Russia and Ukraine, we had really high inflation. They have to boost interest rates, hike interest rates in order to combat that inflation. In 2023, things became a lot unclearer because they were like, okay, inflation went down, however, interest rates are still high. What will the Feds do? Will they lower them at this stage or will they keep them high? What will happen? It was an undecisive market. And we see it happen oftentimes where we don't know what will happen with the Feds. And even the Feds are throwing out mixed signals. We don't know, we might increase, we might lower, we don't know what we're going to do. And therefore that creates an undecisive market. And therefore in 2023, we've seen Bitcoin hover between $25,000 and $32,000 right here. And therefore, if during those 1, 2, 3, 4, 5 months almost, you were using a breakout system, right here, your system most probably would have bled money because this is an indecisive market condition. So as you can see, using your breakout system right here, good, impulsive up. Right here, higher interest rates, impulsive down, good. Here, bleeding money because it's an indecisive market. The Feds don't know whether they should raise rates or lower rates. Inflation is lower, investors are confused, indecisive market, which led to this breakout system basically bleeding money in those conditions. So a trader could have been making money for the past 2 years, very happy about himself, and then in 2023 when that indecisive market condition showed up, he still used his system and he suffered losses. As a result, it is very essential to basically determine what is the right market condition to use with your system, and it is essential to know how to clearly, for example, in that case, we used interest rates and liquidity, how to clearly assess what market condition are we in right now, because that tells us whether we should use our system right now or whether we should avoid using it on this specific instrument and maybe go use it on some other instrument that exists in an environment that we can trade. So let's answer the two questions that I asked in this video. The first question, how do I identify the market condition that favor my system? Now guys, there's not like 75,000 market conditions. The market is either impulsive up, or it's impulsive down, or it is undecisive and consolidating. Those are the market conditions. Now, if you don't know which of these favor your trading system, all you need to do is test your system in all three market conditions in order to see where your system prints the most money and where your system bleeds the most money. As simple as that. Now, for some systems, it is very clear. It is very clear that a breakout system works best when the market is impulsive in one direction. And therefore, it works the least when the market is consolidating. It's very clear. It's very clear if the way that you trade is you draw a resistance and you draw a support and you wait for the support to be tested so you buy and you wait for the resistance to be tested so you sell. It's very clear that that system works best in undecisive markets. So you have to search for undecisive market conditions. Therefore, the second step is that you need to create a framework that evaluates the market condition we're most likely in. So most people assume that the way to identify what market condition we're in right now is to look at the charts. It's like, Roy, look at the charts. The market is impulsive up, which means I need to use a breakout system with this market. No, by looking at the charts, you identify the market condition that we were in the past. You are not identifying the market condition that we're in right now. The framework to identify what market condition we're in right now is something like the system that I've developed for Bitcoin, which means if I anticipate that interest rates are going to be going down and down and down and down, I anticipate that people are going to be having more money. I anticipate that Bitcoin prices or crypto prices are going to go up. If I anticipate that interest rates are going to be continuously going through to the upside because we have high inflation as a result of a war between Russia and Ukraine, then I anticipate that as a result of these interest rates going up, people are going to have less money and this is going to be impulsive down. If I don't know where interest rates are going, I'm confused, similarly to other investors, then I understand that we are in an undecisive market condition and I shouldn't use a breakout system in that market condition. As a result, you develop a framework that basically anticipates and evaluates the market condition that we are likely to be in right now. The third step, if the instrument you're trading, this is the most important thing and many traders fail because of that. If the instrument you're trading isn't in a market condition that allows for your system to strive, look for another instrument to trade. Now here's the thing, guys. Majority of traders pick one instrument to trade. They're like, okay, we are going to trade NQ for the rest of our lives, or gold for the rest of our lives, or Bitcoin for the rest of our lives. And I'm like, okay, you're free to do whatever the fuck you want. However, you need to be aware that these instruments will go through conditions where your system will not work in these conditions. And therefore, you have to avoid using your system in these conditions. As a result, what I personally do is if I'm evaluating an instrument right now that I want to trade and I find it to be in a market condition that I dislike, I go ahead and I look for another instrument that exists in a market condition that I like. For example, when we went and we analyzed Bitcoin and gold, if you're a breakout trader and you're like, I only trade Bitcoin, you will lose, because at some point Bitcoin will go through a market condition in which it's indecisive and your system will bleed money. So instead, when you anticipate or when you evaluate that Bitcoin is in a market condition that is indecisive, let's say you lose those two trades right here. And then you're like, okay, maybe I need to think about what I'm doing here. And you reevaluate Bitcoin and you find that it's in an indecisive market condition. What you need to do is you need to go look for another instrument that is in a market condition that favor your system. In that case, that was gold. Gold, that year, if you're a breakout trader, that would have favored your system. And therefore you were like, okay, I don't want to trade Bitcoin anymore because it is not in a market condition that favors my system. I'm going to trade gold for now because it is in a market condition that favors my system. Search for the environment that favors your system. Do not stick to one instrument because that's what you heard on the internet. You need to stick to one instrument and be loyal to it. And no matter if it goes through a period of huge drawdowns, you need to continue being loyal to it no matter what happens. No, search for the environment that favors your trading system. All right. Finally, basically, that's about it. That's why I wanted to speak about this. That's why I hate trading one instrument, because I believe that all instruments go through market conditions that are unfavorable for our trading systems. And when they do that, I don't give a shit. At the end of the day, a chart is a chart. I give up on the instrument and I go look for another instrument that exists in a market condition that favors my system, and then I use my system there. That's it, right? That's why I don't stick to one trading instrument. I have a huge watch list and I continuously look for instruments that exist in market conditions that are good for my system. That's it for this video. I hope you guys enjoyed this presentation and I'll talk to you guys again soon. Good luck and let me know in the comments if you liked it.